In 2007, the greatest investor alive made a bet, $1 million, that a fund run by nobody, picking nothing, that anyone can buy, would crush Wall Street's smartest, highest paid geniuses. He challenged the entire hedge fund industry to prove him wrong. Only one man was brave enough to step up. 10 years later, it wasn't even close. Let's start with a choice. Your choice. Imagine you've got money to invest, and you're standing in front of two doors. Behind door number one, a plain, boring fund that just buys a tiny piece of America's 500 biggest companies. No genius running it, no strategy, almost no fee. Behind door number two, the smart money. Exclusive hedge funds run by the sharpest minds on Wall Street people with secret strategies, elite connections, and a track record of looking very, very impressive. One door feels like settling. The other feels like winning. Which one do you walk through? Almost everyone reaches for door number two. Of course they do. Why would you bet on average when you could bet on genius? In 2007, one man stood in front of those exact two doors and very publicly bet $1 million on the boring one. That man was Warren Buffett, and he made a claim that sounded almost arrogant. He said that over 10 years, a simple, cheap index fund would beat almost any collection of hedge funds a professional could pick, once you counted the fees. Then he put $1 million behind it and challenged the entire hedge fund industry to prove him wrong. Think about who he was talking to. Thousands of managers who'd built fortunes telling the world they could beat the market. And when Buffett issued his challenge, silence. Out of that entire industry, exactly one man stepped up. His name was Ted Sides, from a firm called Protege Partners. The terms were simple. 10 years, 2008 to 2017, $1 million to charity. Buffett would put his money in a single S&P 500 index fund. Ted would pick 5 funds, and inside those 5 sat more than 100 different hedge funds, hand-selected by experts, all working to win. 100 plus of the smartest minds on Wall Street, against one fund that just sits there. Both sides were completely confident. Only one could be right. To understand what happens next, you need to see what's really racing here. In one lane, the Hare, the hedge funds, brilliant people, secret strategies, the freedom to bet on almost anything, even to make money when markets fall. But there's a catch, and it's the whole story. Their price. Hedge funds famously charge what's called 2 and 20. 2% of all your money every single year just for holding it, plus 20% of any profits they make. And here's the killer. Ted's money sat in funds of funds, which stack a second layer of fees on top of the first. In the other lane, the Tortoise, the index fund. It does nothing clever. It just owns all 500 companies and sits there. Its fee, a few dollars a year for every 10,000 you put in, almost nothing. One racer is dazzling and expensive. The other is boring and nearly free. Buffett bet everything on boring. And at first it looked like a terrible bet, because year one was 2008, the worst financial crash in living memory. The index fund, holding nothing but stocks, got hammered, down 37% in a single year. The hedge funds, this is exactly what they're built for. They hedged. They cushioned the fall. They dropped too, but only about 24%. In the middle of the wreckage, the pros were clearly winning. If you judged the bet after year one, it wouldn't have been close. The geniuses were crushing the boring fun. Even Buffett felt it. He said, and this is barely a paraphrase, "I just hope Aesop was right, that the tortoise overtakes the hare." The hare was way out front, and then the race actually started. The market bottomed, and then it began to climb, and the boring little index fund started doing the only thing it knows how to do, grind upward year after year, right alongside the American economy. But here's the part you can't see in the headlines. Every single year, whether the hedge funds won or lost the fees came out. 2% here, another layer there, 20% of the good years. Money leaving the pot over and over. No matter what happened, the tortoise had almost no leak. The hare was bleeding cash with every step it ran. Year by year, the gap closed, then it flipped. By the 5th year, Buffett's boring fund had pulled ahead for the very first time, and it never gave the lead back. The tortoise wasn't faster. It just never stopped, and it never bled. So how did it end? Let's look at the scoreboard. Over the 10 years, Buffett's index fund gained about 126%, roughly 7% a year, quietly compounding. The 5 hand-picked hedge fund baskets, over the whole decade they returned 22, 42, 88, 3, and 27%. Average those out, and it comes to about 2% a year, 7% versus 2. It wasn't a contest, it was a demolition. Ted Seides saw it coming and conceded before the clock even ran out. His exact words, "For all intents and purposes, the game is over. I lost." And to his real credit, he named the reason himself: the fees. The prize, which had quietly grown to more than $2 million, went to a small girls' charity in Omaha. A fund run by no one had just beaten 100 of the smartest people on Wall Street. But before you swear off every professional forever, the real story is more honest than that. Because this bet did not prove that hedge funds are useless, or that an index fund always wins, and the honest version matters more than the headline. Remember 2008? The hedge funds fell far less than the index. For someone who can't stomach watching their money drop 37% in a year, that protection is worth something real. Next, the timing. Those 10 years were one long bull market, a powerful tailwind for stocks. Rewind to the decade before 2000 to 2010, and the S&P 500 went almost nowhere, while the average hedge fund actually made money. Buffett himself admitted that a weak market would have helped the other side, and a rare few managers genuinely have beaten the market for decades. One legendary fund averaged nearly 40% a year. But funds like that are almost always slammed shut to ordinary investors. So no, index good, everything else bad is too simple. Here's the honest lesson the bet really teaches. Fees are a silent, relentless drag, and most professional managers, not all, but most, fail to beat a cheap index fund after those fees, over the long run. Not because they aren't smart, but because they're expensive. And that's the quiet truth that can change how you invest for the rest of your life. A fee of 2% sounds like a rounding error. It isn't. Over decades, that small percentage taken every year, win or lose, compounds into an enormous slice of the fortune you could have kept. It's a tax you volunteered to pay, and most people never even notice it. So here's the freeing part. You don't have to be brilliant. You don't have to pick the winners. You don't have to find the genius. Buffett's whole point was that owning everything, cheaply and simply waiting, quietly beats most of the geniuses, because their costs work against them every single year, while time works for you. It's the same lesson underneath every story on this channel. It was never about being the smartest person in the room. It was about not letting your money leak and letting patience do the heavy lifting. And if you're wondering whether Buffett actually believes this, here's your answer. He has said that when he's gone, the money he leaves for his wife should go mostly into a simple, low-cost S&P 500 index fund, the greatest stock picker who ever lived, telling the person he loves most to just buy the boring thing and hold it. Maybe that's the whole secret. So the next time someone offers you smart money, you'll know what to ask. And next time on this channel, we're breaking down another quiet truth about wealth that Wall Street would rather you never learn.